Welcome to Business with Louis, the show where we explore the fascinating world of entrepreneurship and economics. I'm your host, Louis, and today we're going to dive into a crucial concept that can make or break businesses: fiscal policy versus monetary policy. To start, let's define what these two terms mean in simple language. Fiscal policy refers to the government's use of taxation and spending to influence the overall level of economic activity. Think of it like the government's wallet. They can choose to spend more or less, tax more or less, and that affects how much money is circulating in the economy. On the other hand, monetary policy is controlled by central banks, like the Federal Reserve in the U.S., and involves managing interest rates and the money supply to promote economic growth and stability. Understanding the difference between these two policies is vital for businesses because it can impact everything from consumer spending to investment decisions. For instance, during an economic downturn, a government might implement expansionary fiscal policy by cutting taxes or increasing government spending to stimulate demand. Meanwhile, a central bank might use monetary policy to lower interest rates, making borrowing cheaper and encouraging businesses to invest. One key concept is the multiplier effect, which suggests that an increase in government spending or a tax cut can have a ripple effect throughout the economy, leading to even greater economic growth. This idea was popularized by John Maynard Keynes, who argued that government intervention can help stabilize the economy during times of crisis. Another important theory is the concept of crowding out, which occurs when government borrowing drives up interest rates and reduces private sector investment. This highlights the delicate balance between fiscal and monetary policy. If the government borrows too much, it can actually harm the economy by reducing private sector activity. To illustrate these concepts in action, let's look at some real-world examples. During the 2008 financial crisis, many governments around the world implemented expansionary fiscal policies to stimulate their economies. In the U.S., for instance, the American Recovery and Reinvestment Act provided billions of dollars in stimulus funding, which helped create jobs and boost economic growth. On the other hand, monetary policy has been used extensively in recent years to manage inflation and stabilize financial markets. For example, during the COVID-19 pandemic, central banks around the world cut interest rates and implemented quantitative easing programs to inject liquidity into the economy and support businesses. So, how can you apply these concepts in your own business or career? First, stay informed about economic trends and policy changes that might affect your industry. Follow reputable sources like the Financial Times, Bloomberg, or The Economist to stay ahead of the curve. You can also use online resources like the Federal Reserve's website or the International Monetary Fund's publications to deepen your understanding of fiscal and monetary policy. Another tip is to diversify your investments and manage your risk exposure. If you're invested in stocks or bonds, consider hedging against potential interest rate changes or economic downturns. And if you're a business leader, make sure to maintain a healthy cash reserve and be prepared to adapt to changing market conditions. For instance, companies like Tesla have been impacted by changes in government incentives for electric vehicles. As governments around the world introduce or modify these incentives, Tesla must adapt its pricing and marketing strategies to remain competitive. This requires a deep understanding of fiscal policy and its potential impact on the automotive industry. In addition, it's essential to understand the impact of fiscal policy on your supply chain and industry. Changes in tariffs or trade policies can affect the cost of raw materials, labor, and transportation. By staying ahead of these changes, you can adjust your business strategy to minimize risks and capitalize on opportunities. To take it a step further, consider how fiscal policy can influence consumer behavior and demand. For example, if a government implements a tax cut, consumers may have more disposable income to spend on goods and services. On the other hand, if a central bank raises interest rates, borrowing becomes more expensive, which can reduce consumer spending. In conclusion, understanding fiscal policy versus monetary policy is crucial for businesses and entrepreneurs who want to navigate the complex world of economics and make informed decisions. By grasping these concepts, you'll be better equipped to manage risk, capitalize on opportunities, and drive growth in your business. Remember that every great business starts with a deep understanding of the economic landscape. Stay curious, stay informed, and always be prepared to adapt to changing market conditions. Join us next time as we explore more topics at the intersection of business and economics. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.